Earnings per share is the company's net income per share of common stock. It's calculated by taking net income available to common shareholders, which is net income minus dividends for preferred shareholders and minus income attributable to non-controlling interests, and dividing it by the weighted average number of common shares outstanding. We use net income available to common shareholders in the numerator because companies only report earnings per share for common shares. And we use a weighted average for the number of common shares in the denominator because new stock issuances and stock repurchases can cause the number of shares to fluctuate during the period. Now, earnings per share is the most widely used measure of profit. It's the only ratio that publicly traded companies are required to report on the income statement. Both US GAAP and IFRS require this. And earnings per share is the accounting metric you'll hear most about in the financial news, particularly during earnings season. Publicly traded firms release their earnings 4 times a year at the end of each quarter. And analysts try to predict what their earnings per share will be. And those forecasts are compiled into what's called a consensus estimate. The company then releases its quarterly results, which includes its earnings per share figure. And then the executives of the company go on a conference call and explain why the company did or did not reach its forecasted earnings target. If earnings per share happen to be higher than what analysts had expected, this is called an earnings beat. If earnings per share happens to be lower than what the analysts had expected, this is called an earnings miss. Stocks often go up when there's an earnings beat, and they often go down when there's an earnings miss. So why do people care so much about earnings per share? The answer has to do with valuation. Many investors value companies based on their expected future cash flows. So analysts spend a lot of time trying to figure out what those future cash flows will be. And what's the best predictor of future cash flows? Surprisingly, it is not current cash flows. It's earnings per share. That's right. A company's current earnings per share is a better predictor of its future cash flows than the company's current cash flows. This explains why stock performance is more correlated with earnings per share than it is with operating cash flow. But that's not all. When you divide a company's stock price by its earnings per share, you get something called the price to earnings ratio, or PE ratio for short. The PE ratio is also known as an earnings multiple, and it's a quick way to assess the relative value of a stock. Companies with high PE ratios are considered to be expensive, whereas companies with low PE ratios are considered to be bargains. You can benchmark a company's PE ratio against the industry average, against the average for the market in general, or against the PE ratio for a competing firm. For example, if you have 2 similar companies in the same industry, the one with the lower PE ratio will generally be seen as a better value. This is an important principle in value investing, where investors seek out companies with a low PE ratio. The main downside of the PE ratio is that it doesn't account for growth. Company A might have a higher PE ratio than Company B because investors expect Company A's earnings to grow faster. To address this, some investors use the price to earnings to growth ratio, or PEG ratio for short. The PEG ratio divides a company's PE ratio by its growth rate for earnings per share. So we've seen that earnings per share is incredibly useful both in predicting future cash flows and in calculating the PE ratio. But when it comes to being a measure of performance, earnings per share isn't perfect. For one thing, earnings per share does not account for the amount of assets or capital that had to be employed to achieve those earnings. For example, let's say that 2 companies each had $5 of earnings per share. It seems like they did equally well. But what if one company had $500 million of assets, whereas the other company had assets of just $10 million? Both companies achieved $5 of earnings per share, but the second company did so using a lot fewer resources. This is where a metric like return on assets, ROA, can be really helpful. But there's another issue with using earnings per share as a way to measure a company's performance. It can be increased simply by repurchasing shares. Let's say a company's profits are flat and there's no growth. If the company repurchases some common shares, earnings per share will go up, even though there's been no improvement in the company's performance. In fact, it's even possible for net income to go down, yet earnings per share to go up if the company repurchases enough shares.